Good morning, students. Welcome you all to the 24th session of the Advanced Financial Management. Today in this session, we'll see under the chapter Cost of Capital and Capital Structure. Today we'll see the factors influencing capital structure. Means what are the different factors or what are the different parameters or the different market conditions we need to consider while designing the capital structure. What are the different factors which makes an impact on our decisions while designing the capital structure of a company. The outcome of this session is to make you able to explain the factors or the various parameters which have impact on designing the capital structure of the company. As the capital structure deals with the qualitative aspect, how best you can make the decision whether to acquire which sources at what cost, so that whatever the profit is available after paying all the costs regarding available to the equity shareholders will have a impact on the market value of the firm. In the previous session, we have dealt with the capital structure, that is the combination of various sources of long-term funds. The difference between the capital structure and financial structure, as I said, capital structure is the qualitative aspect. It is related to the long-term sources of funds acquired by the company, and capital structure forms a part of financial structure, whereas financial structure is a broader concept which includes both the long-term sources as well as short-term sources. And also we have dealt with the patterns. What are the different patterns in which it can design its capital structure? That is only equity and debt, equity and preference and debt, and equity, preference, debt, and all the long-term sources where it can design its capital structure. So the different parameters or the factors which influence capital structure are explained under the various heads. First is leverage. Leverage means it is the basic and important factor which affect the capital structure. What is leverage? It is related to the fixed cost, means acquiring the debt and paying the fixed cost so that it will enhance the market value of the equity shareholders by paying a higher returns. Leverage means it is a balance, or we can say it is a leverage means it is the financial position of the company. It is the operating efficiency of the company where it can acquire the debentures so that it can minimize its cost of capital and enhance the value of the firm. Next is market. Market also plays a vital role in designing the capital structure. We need to see what are the different sources of funds available in the market, at what cost, or in what combinations they are available, and also prevailing market environment. That is, prevailing market environment means it's made by investors' behavior. It might be rate of interest for the different funds. That also influences the capital structure of a company. Next is investors' behavior. So the people who provide the funds for the business, those are the investors. Their mentality, their perception, their risk-taking capacity, their knowledge, and also the options available for the investors. That is, investors' behavior affect the process of capital structure. Well-educated investors. Today we know that each and every investor is having the information about the market. What are the different rate of interest given by the company? What are the different sources of investment options are available for the investor? If I'll invest in equity market, what is the rate of return I can expect? If I invest in debt market, what rate I can expect? So the investor is having the huge information. Information is freely available for the investor to make the decision whether to invest in the market or not. So investors know the prevailing rate of return in the market and change their behavior accordingly and demand more return based on competition for funds from different companies. As such, investor behavior also play an important role in designing the capital structure. The company should understand the mentality of the investor so that whether to acquire funds through issue of equity shares or through debentures. Next factor is business risk. Business risk means the risk in earning the profits. the risk in managing the cost of the business, and also the operating efficiency also comes under the business efficiency. The greater the firm's business risk, the lower its debt ratio. Means business risk means what? It's an inability of the company to generate sufficient profit to pay the cost, to pay the interest. So if the business is under risk, if there is more competition for the business and business is not earning profits as expected, then it is called as business risk. It is the risk which is measured by the inability of the firm to generate profit to cover its operating cost. First, when it earns the profit, it has to manage the operating cost because it has acquired the funds to acquire the assets for the company to generate the profits. So, it is the inability of the company to meet its operating cost is called business risk. It also influences the capital structure. So, the firm should be very cautious. If it is earning good profits, if it is earning stable profits for all the years, then it can go for debentures. If it is not earning, if its profits are uncertain, then the company should depend on the equity share. So it also affects the capital structure of the company. Inflation. Inflation means rising cost. It's an increase in the prices. So it is an impact on the investment pattern of an individual. If an individual investor has higher borrowing capacity, he goes for risky returns. If he is having higher borrowing, he can get the funds at a lower cost. It can, if an investor is having more options of getting the funds, he can go for risky investment. He can go for investing in equity market if he is getting interest at a lower rate of interest. In case of inflation, if his borrowing cost is high, then he don't come forward to invest in the share market. Then the company should consider even the inflation prevailing rates of interest while designing the capital structure of the company. Next is cost of capital. Cost of capital also influences the capital structure. A best or an efficient financial manager is one who acquires the funds at a lower cost, so that he can enhance the value of the firm by paying high return to the equity shareholders. So cost of capital also should be kept in mind. At what rate I am getting the funds, whether I am able to generate so much profit to pay the cost. He has to consider all the cost of capital for deciding the capital structure of a firm. Normally, long-term finance such as equity and debt consist of fixed cost, while mobilization, when the cost of capital increases, value of the firm will decrease. So, businessmen should keep in mind the cost of capital while designing the capital structure. Next is nature of the business. Use of fixed interest or dividend-bearing finance depends upon the nature of the business. That is, if the business consists of long period of operation, means if it is a longer period, if it is getting the profits after a long period of operation, then it will apply for equity then debt, and it will reduce the cost of capital, because if it is earning the profits in a shorter period of time, then it can go for debt. If it is earning the profits after a longer period of time, then it's better to go for the equity. Another is size of the company. It also affects the capital structure of a firm. Larger the size of the company, it can manage the investments through its own sources. It is having a higher capacity. It is having huge funds. It is strong in the finance. Whereas in case of smaller companies, they don't have that much finance to carry their operations, so they have to depend on the external sources at higher cost. So it might impact their capital structure. So even the size of the company also matters in designing the capital structure of the firm. Next, government policy. That is, promoter contribution is fixed by the Company Act, whereas in banking sector, there will be some rules and regulations while raising the capital from the market. They have to maintain promoters' capital should be this much percentage. They will fix by the government. So promoter contribution is fixed by the Company Act. It restricts to mobilize large. The company cannot go and mobilize all the funds which is required to run the business. It has to maintain some percentage of the finance or some percentage of the capital should be contributed by the promoter as per the Companies Act, and longer term funds from external sources. Hence, the company must consider government policy, government rules regarding the capital structure. Even the Fiscal Act of the government, even the monetary policy also affects the capital structure of the company. Next is competition. The competition to acquire the funds. If there are number of businesses, if there are number of firms which are raising the capital, then it will be giving a more option for the investors. The volatile capital structure is based on competition. Due to available opportunity for the investor in the competitive market, he has the different option for his investment. So he cannot say yes for the lower rate of interest. Thereby, the demand for the required rate of return will be highly volatile, because if the investor is having huge options, if there are 10 companies which are in the forefront to raise the finance, then the investor is having huge options to ask for higher rate of interest. So if competition is very less, if few companies are raising the capital, then investor is also having fewer options, then he has to adjust with whatever the rate of interest is provided by the companies. This leads to change in the capital combination in accordance with the highly expected returns. So some of the multiple choice questions. Factors influencing capital structure decisions are inflation, cost of capital, size of the company, all of the above. The answer for this is the factors. Inflation is also the factor, cost of capital is also one of the factor, and size of the company is also one of the factor. Inability of firm to generate profit to cover up its operating costs. As I already said, this risk is termed as business risk. Increased cost of borrowing funds is related to what? It is related to inflation. In general, when the cost of capital increases, then the value of the firm, in general, it decreases. Using of debt to acquire assets to earn returns greater than cost of debt is referred as trading on equity. So this is about the factors influencing capital structure decisions. Thank you.